All right, welcome to the Hurley Investments Trade Finding or Adjustments for Tuesday night on the 12th of February. Our next one that I'll be having will be on Thursday, February 14th, and I'm going to be doing that one at 10 a.m. Mountain Standard Time. So, working on through today, I thought of a couple neat ideas. If you haven't been following along, go back along to last Thursday when I talked about Disney and the common sense of trading and advisory. Anyone remember what I pointed out last week? Anyone remember? We got 13 of you here today. What did I point out last week? Don't just place the trade. Follow that day's trend, news events, and be ready to not place a trade if you can't get the credit / net debit / setup that the trade requires. You want to know the biggest problem with all those people that are out there suggesting trades? They're paper trading it. They stick it on all the time. They tell you, hey, over a year's period of time, my trades are profitable. Well, maybe if you're in a paper trading account because you didn't fight through the emotions of watching your portfolio disappear by half. None of those jokers are placing real trades on every single trade. None of them are getting a real return at some bogus number, because if they were in a real account, what would happen? What would happen if someone was getting a 97% profitable trading ratio and 250% returns? What would happen after 2 years in a row? Someone tell me. What would happen after 2 years in a row if that was to happen? There you go. You got it. They'd be bought out. If their system was that good, they'd be making billions of dollars from Morgan Stanley, Goldman Sachs, JP Morgan, overseas in Europe. Billions of dollars. So don't waste your time and money on that. Here we go. Back to Disney. Is Disney a better trade today than last week? And that's interesting. So I've got 3 that I'm looking at today that I want to work on. If I was looking for a Disney trade, I'd probably still be looking at that same 3-day trade. Don't want to do it on Facebook, want to do it on Disney. And let's be serious. I would obviously start off looking at a chart. If I was to look at a chart, so disappointing. So disappointing. My chart stops me right now. My chart stops me and tells me, you know what? That Disney trade is not a trade that's ready to be put on. What tells me that that trade is not ready to be put on? Taking a look at the chart here, what tells me that that trade is not ready to be put on? Oh no, I've got a got something popping up here. Let's get that into my sorry guys, I should have this a little better prepared. Still learning as I go through here. Still learning. Looking at this chart, number one thing that tells me this trade is not ready to be put on. Survey says 108 support. True. Violated support. True. Indicator still negative. Not turned. True. Those are all true. All correct. Really what it comes down to, if I was looking at this plain and simple, right? I want to put a bull put, technically bearish up above. Let me go to a highlighter. Technically bearish up above, technically bearish down here. I do have support. I could use the 200-day as support, which is at 109.29. We're at 109.20. So technically it's violated the 200-day as well. I do like the pennant looking. It's a short-term pennant. You could go a little bit longer term this way. You could do it this way. You could do it that way. You could do it this way. Kind of weird. Taking a look at this one, I could do a short-term pennant where it's definitely coming to a square there. I could even do a little bit longer term with the shorter term there. Being pinched by the 200 and the 50. God, such good earnings, but really, I want to see a bounce off of the Williams percent R. That's telling me where more money is going back in. So yes, it's not quite ready. We could see it maybe later on today or tomorrow, excuse me. If I was looking at it for just doing a short-term bounce on my 3-day trade, I could look at I could look at a 3-day 108, 118. Wow, that's excuse me. Let's do 111.34. So we do 111 minus 0.34. We'd be looking at 77 cents on a 3-day trade, but we would really need to see the bounce, and those are pinching so much on that. So much right here. Wonder if we stuck Bollinger Bands, if that would make it look any different. We change this and put in some Bollinger Bands here. Wonder if those are pinching as well. Actually, they're spreading out down to the downside. So we might have already had our pinch and it's violated the Bollinger Band, but it's down below the Bollinger Band, which could tell me, again, we're looking at a bounce off of this. We'd be looking at a bounce here. Because it violated, went outside 2 days outside of the Bollinger Band. That should bounce back in pretty quickly. Boy, a 108, 110 for 77 cents is a possibility. It's a possibility, but it's not a smart trade. The short answer is it's a possibility for a 3-day trade at 108, 110 bull put to exit in 1 day with half your credit of 77 cents. Interesting, interesting. All right. Here's what I was looking at that intrigued me. It was right here. It's not Farmers Insurance. I need to figure out how to get that so it doesn't do that anymore. It always does it. I thought I blocked those pop-ups that way. I really liked Under Armour, but I also see it's bounced outside of its Bollinger Bands. Let's go back to pivot points. As I look at Under Armour, I'm going to show this a couple different ways. Look at its stop right at its resistance at 2247. 2247, that is a pivot point or a retracement. 2247 hit just on it and bounced lower for the end of the day. So it had to break that. Chances are it'll only get up to 2420. It'll be overbought at that point, which it really doesn't do. More or less stays away from being overbought. It can stay overbought on Williams percent R for an extended period of time, but it usually doesn't. It was that extended because people were buying in at the beginning of the year. So I'm going to pull open a little something I have. I think Under Armour would be a good purchase. My purchase on Under Armour is at cost basis at 21.16. Got in at 22.50, but I picked up 100 shares with a protective put. A real wild ride this morning. It was down over 6%, well, 5.78%. Finished up today, 7%-ish to 22 cents, 6%, 6.5%-ish points. But I have some short-term long puts. So pretty interesting. I would tell you it would be a good purchase to get in right now if you got into the stock at $22.21. What would be your exit point? If you were to go ahead and buy right now, if you were going to buy Under Armour based on what we just saw on the chart, if you got in, where are you getting out at? Where's your point where you're going to take money off the table? $22.34. It's actually $22.47-ish. So you're probably looking at the $22.40. And do the math. It's kind of simple math, right? Should be relatively simple math. You could enter a buy to open at a stock price of $22.21, right? Pretty sure that's what I saw. Probably should snap a picture of this chart as well, since we're using it. There's a camera sound that comes with it. So Under Armour. Using our chart, making some of our decisions. Just got through a volatile earnings, but it makes perfect sense. You could buy to open the stock at $22.21. Looking to exit at $24.20 for a net profit of, and just do your calculators here, $22.21 minus $22.40. Can't type. $22.41. $22.21. Crying out loud, Hurley. $22.21 minus $24.20. You would get out of it a $1.99 profit, or a ROI of 22.21, or an ROI of 8.95%. Maybe not too bad of an idea. If you could do 1,000 shares, you'd walk away with about $1,990, maybe $1,980 with commissions. Pretty neat opportunity there. Second opportunity. I don't have $22K to spend, so work on a bull call. Again, I would probably do a March, maybe do an April 22.24, going in the money because of where we're at. Looking at Under Armour. I'm going to get to that question in just a second. So if we did a March 22.50.25, I don't like it. Do a March 22nd. I want different strikes. There we go. I really like this one. A March 22.50. So a March 22nd, 22.50 long call for $1.17. And then you can go out to a 24.50 for 25 cents of credit. Let's work our numbers. Let's work our numbers and see if that is going to see if that's going to work out. Then I'm going to go look at April. So let's look at a March 22nd, 19 bull call. I'm slightly out of the money. So we're going to spend buy to open the long call for a $1.17, subtract the short call strike of 24.50. So they're buying to open the 22.50. Credit of 25 cents. So we're trying to make $2 at a cost basis of 117 minus 0.25, 92 cents. So it's a 92 cent net debit, which is also equal to your risk in the trade. maximum reward is the difference in strikes, which is equal to $2 minus the 92 cents. So the most you could make is $1.08. I like that, taking 92 cents divided by $2. So it's like, well, let's do $2 divided by 98 cents. It's basically a 1-to-1, 1-to-1 risk to reward. That makes sense. That's a smart trade for me. That seems to make sense. Now, let's go check. Let those numbers speak to you. Let's go check in April. In April, let's have less time decay on it. We might not get the same strikes, though. So if we did in April, we'd have to do a 22.50.25. And check out those numbers. $1.33, right? Minus 40 cents. Crying out loud. Wish this would just work here. So sorry about that. My calculator's not working. $1.33 minus 40 cents. 93 cents. 93 cents is what it would cost us to go out another month. $0.93. But we'd get an extra 50 cents of potential profit. So this is where you ask yourself the question, would you spend money? Would you spend money, and would you spend an extra penny for an extra month for the stock to move and for 50 cents more credit? $1.33, 40 cents, 93 cents. So you could do, I mean, it's kind of where it speaks to you, right? You could do in April 22.50.25 for a net debit of, can't spell, 93 cents. You get an extra 4 weeks, maybe even 5 weeks. Let's check it out. March expiration, you get 1, 2, 3, 4, 5 weeks. An extra 5 weeks for the stock to move and an extra 50 cents of profit. Which one would you do? Which one would you do? There are 14 of you here now. Rich says the April. Lance and David say the April. Mary, how about you? Maud, how about you? Abraham? Definitely April. So, boy, all you guys are April, huh? Mary? April. Longer day. Yeah, you know what? It gives it more time to work. You guys are killing me. I would choose the March, but I would choose the March because the delta here is 27 cents. the delta in my March 22nd is what I was looking for. The delta in my March 22nd ones would be 49.21. So I would make 28 cents. I'd make 28 cents. The reason why I would do it, in all honesty, comes right back to looking at the chart. In all honesty, I would probably be March because I don't think it's going to get up to 25. Yes, it has come close in the past, but those pivot points are different places. I do think it'll break the 2047 or get close to it, but I don't think it's going to go much higher than 2420. It just would extend the stock too much on a shaky earnings report. Someone made a question, asked, would you do a diagonal? Would I do a calendar on it? Again, I would not do a calendar on it either. For the two reasons, it usually moves too fast, too quickly. So a long, call calendar would not be in my interest. I'd also want that, because it moves quickly, I would want that long call to have a bigger delta than my short call would. But really, it's because of the technical setup. Not sure if it would run up to 25. Not sure. It would run with a China trade agreement or trade extension or no tariffs or no tariff raise. But I don't think China's getting done by April. I think we'll have an extension in March for another 3 months. And I think this will be what will really move our market in June. I think this earnings event, we kind of trade sideways till the next earnings in April. And really, what moves our markets will be China. But 1 penny puts either one into a good place. Either one into a good place. I'd also, based on what I see on my positions, if you don't forget here, if you remember, of course, they're my positions. I've got in this little fund of mine, I've got a short put. Excuse me, I've got a long put at 21.50, only worth 11 cents. So I could short puts against this at 21 for February 22nd. If you could take a peek at this one, if you wanted to open up a new position, a 2050, 2150. Let's see if there's any credit in it out to February. A February 2050 to 2150 is only 9 cents. That wouldn't work. 14 to 39. I would also say that would not work, as it only has 25 cents. I typically always want to run a debit spread of 40 cents or more. So if I do have few contracts in place, an adjustment doesn't take away all the profit or make it not worthwhile for me. If I was to look at a March bull put, a 2025 is 75 cents, but that's putting it in the money. A 2017.50 does not have the credit there. I need those a little bit harder to fill, but 50-cent increments. Wow, look at the spread there. That's what I'm looking for. On March 22nd, look at the spread. That's wild. 29 to 63 to a 58. I kind of like the spread here. Last traded here at 40 cents. Last trade here was $2.10. Huh. What is 57? The midpoint. What would be a midpoint here? That's unusual. Let's take a peek at this. That is really unusual. Midpoint would be 46 cents, so I would take that one. But I'd probably push this one up to a 55 center. $46 and 69. 57.50. $57. So there's a spread for a limit credit at 20.50 to 25, where I'm going to take one risk. I'm going to take two risks. Basically, if it works out, I'll take my 57 cents, but I'll have $1.50 of risk in the trade. And the funny thing is, if I rolled that 11 cents I already have in that long put that I still have dangling on stock ownership, if I was to roll that long put out to a March and capture that 11 cents, this would actually give me a 68-cent credit against $1.50 risk. So you just take that $1.50 risk, divide it by 68. The 68 divided by the $1.50, 4.5. So it's almost a 1-for-1. $0.68 of potential profit against 82 cents of risk. That's like a 1 to a 1.3. Using a position I already had against stock ownership where the stock made more than the long put cost me. That might be the play. I'm looking at this, but it might be a little bit different play. Take this and roll this out to a March 22nd. And then add March 22. And look at that, 57, and I said I'd probably take a 68-cent credit. $57 plus 83 divided by 2. I could even play the midpoint in between these and do a 70. 70 cents a credit against $1.50 a risk. There you go. Kind of interesting. Just a little something that I saw there. All right, guys, questions. Questions. So I'm kind of throwing about 3 trades out there. 3 opportunities, I guess, is what I should say. Mine is an adjustment to long puts against stock ownership. Thoughts, ideas. Kind of interesting. If I was to bring up that trade, modify it. Snapshot analysis is pretty interesting, right? $770 is what I'd look at. Maximum profit, 52% probability. There's a 62.05% probability that I'll at least break even. Risk to reward, 1 risk for 0.87 rewards. Kind of interesting. I'll go back and I'll put this information back in to the working of our other bull puts just so you can see it. But I like this adjustment. This adjustment gives me the heebie-jeebies. I like it. Yeah. I like where it's going. The only question is, can I get filled at where I'm trying to get filled, or do I have to lower it back down at 68 or 65 cents? And the whole reason why is because after hours, the sucker's up another 14 cents. So, 0.63%. It's going to move quickly up to that 24. So can I take advantage of a quick moving up to 24? That will be the question. Any questions, guys? Any thoughts? Any comments? Thank you, Lance. Interesting way to look at an adjustment and create a new trade. I'm only doing that, though, because, in all honesty, I'm only doing that because I am getting killed on these puts, so to speak, but I lost $1.04 to make $1.43 and to get me through earnings. I can live with that. I can take $1.43 gain on $1.04 loss, getting me through earnings. I need to make certain, though, I need to understand that if I convert this into a bull put, I no longer have downside protection. So as I'm taking off or cashing in my bull put credit, whatever it may be, maybe I get 50 of the 70 cents and another $1.40 movement up. Once I do take that off, I have to understand I have stock unprotected, and around 24.40, I'm looking for an odd week, 50-cent difference in strikes to pick up some long puts in case this sucker falls back down like it's done the last times. Remember, looking at that chart, the last 3 times it has not gotten above that 23. Well, I guess it hasn't stayed above that 24.50 for more than a day. 1, 2, 3, 4, 5 opportunities to do so, and it can't hold 24.50. Not saying it can't this time, but 4 times through November and December tells me there are a crap load of stacked up orders to sell out from those that got in at 17, selling at 24, getting out at a 40-ish% return, and out they are. Some maybe got in at 16, 17 there in December. What I see October through November, December, I would expect to see again possibly this time around. The key uncertainty, China. They made all their money from international money this time. A China one would push them higher. Guys, appreciate your time tonight. Hopefully you found this interesting and informative. Hopefully, again, you thought and learned. Do not go and put a trade because someone said it's a good trade. You got to look at it that next day and find out if you like it. I look forward to seeing you again on Thursday. Mon, I'm sorry. Thursday will be in the morning, but I should have it posted here by lunch so that you can at least look at it if you're bored during lunch, if you get a lunchtime at all. I know how busy you are. Everyone have a good evening. Mary, good night. Days, obviously appreciate you being here. Lance, I hope this was helpful. You guys have a good evening, and I look forward to seeing you on Thursday. Bye-bye.